Public Debt Management in Australia's Macroeconomic Priorities by William Mitchell and Warren Mosler. Section 2.2 Financial Stability. The current financial system is linked to the real economy via its credit provision role. Both households and business firms benefit from stable access to credit. An economy's financial system is stable if its key financial institutions and markets function normally. To achieve financial stability, A. The key financial institutions must be stable and engender confidence that they can meet their contractual obligations without interruption or external assistance. And B. The key markets are stable and support transactions at prices that reflect fundamental forces. There should be no major short-term fluctuations when there have been no change in fundamentals. In this regard, Crockett, 1997, states, quote, "Stability in financial institutions means the absence of stresses that have the potential to cause measurable economic loss beyond a strictly limited group of customers and counterparties. Occasional failures of smaller institutions and occasional substantial losses at larger institutions are part and parcel of the normal functioning of the financial system. Indeed, they serve a positive function by reminding market participants of their obligation to exercise discipline over the activities of the intermediaries with whom they do business." End quote. Financial stability requires levels of price movement volatility that do not cause widespread economic damage. Prices can and should move to reflect changes in economic fundamentals. Financial instability arises when asset prices significantly depart from levels dictated by economic fundamentals and damage the real sector. Collapses brought on by injudicious speculation that do not affect the real sector or that can be insulated from the real sector by appropriate liquidity provisions are not problematic. The essential requirements of a stable financial system are 1. Clearly defined property rights. 2. Central bank oversight of the payment system. 3. Capital adequacy standards for financial institutions. 4. Bank depositor protection. 5. An institutional lender of last resort when private institutions refuse to lend to solvent borrowers in times of liquidity crisis. 6. An institution to ameliorate coordination failure among private investors and creditors. 7. The provision of exit strategies to insolvent institutions. While some of these requirements can be provided by private institutions, all fall in the domain of government and its designated agents. However, we argue that none of these requirements rely on the existence of a viable CGS market.